Joining me right now is Portfolio Wealth Advisors President and Chief Investment Officer Lee Munson. Lee, great to see you. Thanks very much for being here. Give us your expectations for the banks and for the fourth quarter earnings season overall.
Well, let me break down the banks real quick. I think Bank of America, all traders really care about are those net interest margins and if they've troughed. Remember, Bank of America had problems last year with their duration. JP Morgan, what are we going to hear? How everything's perfect? But they are going to tell you one thing. They're going to say that they can't really expand that loan book outside of credit cards until the Fed helps them and the macro improves. Wells Fargo, always kind of a basket case. And Citigroup, I think the pitch on Citigroup that they're going to try to make today is that, like all the banks, credit card debt is blooming, and that somehow at Citigroup, because half of it, or about 45% is coming from their private wealth management unit, that credit card debt is somehow safer and have less charge-offs. But here's what's going to be the theme for the rest of earnings season. All four banks are going to talk about cost cutting, some more than others. And when you consider that we're expecting, depending on who you ask, 8 to 11%, earnings growth this year on aggregate, but only about half that's really revenue. This is all about cost cutting for every place this year, and that's not a great way to start the year.
Wow, very interesting and great encapsulation of what we're going to hear from each bank. This week when I spoke with Jamie Dimon, he said, we've acknowledged that we're over-earning on NII, net interest income. What do you make of that? They're over-earning.
Well, they made some really fantastic moves, very different from the other banks. They didn't pile in to billions of dollars worth of long duration debt, where Bank of America, they did the opposite. See, the thing I think you have to think going forward, granted, if JP Morgan can keep over-earning and execute, that's great. But if you really want to look at a dog that might, get better over the year, Bank of America, if that net interest margin starts to trough out, they're going to start to earn and possibly over-earn. JP Morgan, it's just they nailed bond duration, more power to them. It's a great, they deserve some credit for that.
Yeah. And it's been the safe harbor in the storm, right? I mean, that's the stock that investors have wanted to hold as they've shunned other bank stocks in the prior couple of months. But it's all about the macro story and rates and the Fed, right? Let's look at Treasury yields today ahead of the December Producer Price Index, which is out in 2 hours' time. The yield this morning is trading up about 2 basis points at a level of 3.98%. We're still below 4%, Lee. Economists are expecting month-over-month prices for the PPI to be up 0.1%, and year over year up 1.3%. Cheryl Casoni, jump in here because Cleveland Federal Reserve President Loretta Mester says it's premature for the central bank to consider cutting interest rates in March. Cheryl.
Yeah, and obviously with the CPI data we got yesterday, and it looks like PPI, we're going to have a strong print here, another sticky inflation story with PPI today. That's really going to take away that base case for that March cut. And as we've talked about this week, the market may be looking for 6 rate cuts, but the dot plot only is telegraphing 3. And at this point, we might be talking about 2 rate cuts for the year. And I think that's my question to Lee. The market really seems to have gotten ahead of itself in its wish list for 2024.
Oh, absolutely. I mean, I never understood why we're supposed to cut, 6 times or 1.5, percentage points. I mean, the Fed has been consistent since last summer that they're only expecting 3 rate hikes in 2024. I think you're seeing the yields come up on the 10-year because it's clear. If the PPI in 2 hours confirms what we saw yesterday in CPI. And remember, PPI is wholesale prices. PPI is like 5 minutes into the future more than CPI. It's a little less lagging than the CPI. I think all heck could break loose on treasuries. And remember, I don't think there's any law of nature so that treasuries have to stick to a 4% yield or lower right now. Just on volatility on a couple hot prints, you can see a 4.5.
You even have former Treasury Secretary, Harvard University professor Larry Summers saying that a U.S. soft landing is a very real possibility now as inflation cools. But he's also saying markets are getting ahead of themselves. What do you make of this idea that a soft landing is pretty much priced into the market? Are you expecting that? Meaning no recession. Meaning no recession.
When I think of a soft landing, I think of a mild recession. I think no recession, no. I think that's ridiculous. I do. I think we're going to have some type of mild recession. It might even not really register with a lot of investors. But look at October. October repriced in an actual bona fide recession. And the market priced it in. But even if it doesn't come over the next 3 to 6 months, doesn't mean it's not going to come at all. I think that this is going to be a great year where you're going to have opportunities for investors to realize they're going to get ahead of themselves. You're going to be able to buy at lower prices. Maria, I have a problem with math, though. And that's not a general statement about myself. We only have, on the high end, $240 a share aggregate earnings on the S&P 500. I mean, 240 is a little bit high, and you multiply that times the 20 earnings, just basic math, that's 4,800. We're already here. So we're 12 days into the year. We've got to get closer to next year, to December, before we can get that market up beyond 5,000, which involves 10% earnings next year. It's too soon. It's too early. It's January.
Yeah, Lee, we should point out that oil prices are spiking because of the geopolitical conflicts. Would you buy oil here or oil-related companies? Real quick.
Yes, I think oil is underpriced. It's not going to do what tech stocks are going to do. But if you want a good earnings yield, some solid dividends, and some tailwind going into the rest of the year, I think you should look at the oil sector. I worry about our relationship with Saudi Arabia. I just want to state that for the record. They're trying to patch it up with Iran. The longer we're in the Red Sea, the worse it is for Saudi Arabia. What's bad for Saudi Arabia isn't great for us.
All right, Lee, we'll leave it there. Good to see you this morning. Thank you so much. Lee Munson joining us this morning. We want to take a break.